Okay, imagine a company growing its top-line sales by an absolutely staggering 122.7% in just 1 year, driven by the most ferocious tech boom of our generation. Sounds amazing, right? But now, imagine that exact same company burning through over $7.5 billion of cash in a 9-month period just to make that growth happen. Welcome to the Edgar Brief. Today we're cracking open the Q3 2026 10Q filing from Supermicro Computer Inc. You probably know them by their ticker symbol SMCI, and we are translating it into plain English. Quick note before we jump in, we are independent, we're not SEC affiliated, and we are definitely not financial advisors. We use AI to help summarize these incredibly complex documents so errors can happen. Always verify on sec.govs before making any money decisions. All right, grab your coffee, and let's dive into this explainer.
So here's our roadmap for today. We're going to start with context and business model, hit the scorecard, do a moat check, read between the lines, look at red flags, and wrap up with a bottom line.
Section 1. Context and business model.
Take a look at this single number, 122.7%. That is SMCI's year-over-year revenue growth for the third quarter. Today, we're going to unpack a massive, undeniable tension buried right in the heart of this filing. We really need to weigh this staggering AI-driven top-line growth directly against an aggressive, debt-fueled cash burn. This revenue growth is exactly why Wall Street is obsessed right now. But to understand how they actually achieve that, we've got to look under the hood at their engine.
Think of SMCI as the custom home builder of the artificial intelligence world. So how does money come in? Well, they sell total IT solutions. They literally design, build, and integrate massive, complex server systems, storage, and networking at the rack scale for huge data centers. And how does money go out? Just like a home builder has to buy incredibly expensive lumber, copper, and concrete long before the buyer actually moves in, SMCI has to buy billions of dollars worth of incredibly expensive components. We are talking high-end GPUs from companies like NVIDIA and AMD. They buy these long before their customer finally takes delivery and pays the invoice. So basically, SMCI is a custom builder that makes money by fronting the costs for incredibly expensive parts, integrating them into highly specialized racks, and then selling that finished product at a premium.
Moving right along. Section 2. The scorecard.
Just look at this revenue jump. In Q3 of 2025, they brought in about $4.6 billion. Fast forward to Q3 2026, and that number absolutely skyrocketed to about $10.2 billion. The filing notes this is heavily driven by complex, high-priced AI GPU-related products. Those alone grew by over 150% year over year. So yeah, more dollars are definitely walking in the door. Their gross margin, which is basically the amount that sticks around before they have to pay for payroll, ads, and rent, remained relatively flat at around 9.9%. But here is where the story gets pretty wild. This unveils the core paradox of this entire 10Q filing. On paper, for the 9-month period, SMCI reported a net income, so an accounting profit, of about $1.1 billion. Great, right? But look at the operating cash flow. It sits at a negative $7.56 billion. If you're new to reading financial filings, here is the golden rule you need to remember. Profit can be an accounting fiction, but cash actually leaving the bank account is always real. Operating cash flow tracks the physical cash moving in and out of the business from its core operations. Because they have to buy all those expensive GPUs upfront to build the servers, the cash leaves the building months before the accounting revenue is officially recognized. If we had to slap a label on them right now, SMCI is a classic high-growth cash consumer.
Because think about it, when you burn $7.5 billion in cash from operations, you have to get that money from somewhere, right? The balance sheet reality here is pretty stark. Their total debt spiked to about $4.1 billion. They are heavily utilizing lines of credit and term loans just to keep things moving. Meanwhile, their actual cash and cash equivalents dropped down to about $1.3 billion. You have to ask, how long until the lights go out? They are relying heavily on banks and creditors to keep funding this massive growth engine.
Section 3. The moat check.
So why can't a competitor with super deep pockets just swoop in and crush them tomorrow? According to management's own discussion, they claim a few durable advantages. First up is their data center building block solutions. This modular architecture basically lets them build servers like high-tech Legos. It significantly reduces the time it takes to stand up a data center. Second, they highlight a first-to-market advantage. Because they have such tight relationships with suppliers like NVIDIA, Intel, and AMD, when a new ultra-fast chip drops, SMCI is often right at the front of the line to integrate it. And finally, their in-house liquid cooling technology. These new AI chips run incredibly hot. SMCI's ability to seamlessly integrate liquid cooling right into the rack itself is a massive selling point for them right now.
Okay, Section 4, Reading Between the Lines. We need to dig into the subtext of the filing's management discussion and analysis. We really need to uncover exactly why $7.5 billion in cash just walked out the door while they were supposedly making $1 billion in profit. I want to read you this crucial quote directly from the liquidity section of the 10Q. It says, "Increase in the need for working capital due to higher levels of inventory required to support future revenue growth and greater requests for longer payment terms from customers." Let's translate working capital really quick. Think of it like running a very high-end lemonade stand where suddenly the lemons cost 10 times as much. You need a massive pile of everyday cash just to stock the stand before a single customer even buys a cup. SMCI is essentially fronting the colossal cost for these expensive AI parts. They are stuffing their warehouses with inventory to meet future demand, and to make matters even tougher, their customers are turning around and asking for more time to pay their bills. That is a brutal squeeze on cash.
Section 5. Red Flags.
Listen, every company has headwinds buried in the footnotes. We dug around and found a few specific, quantifiable risks you need to watch underneath all that spectacular top-line growth. First, inventory write-downs hit about $239 million for the 9-month period. In the fast-moving AI hardware space, if you hold on to inventory for too long, it becomes obsolete very, very quickly. And they took a real hit for it. Second, tariff expenses. They saw a massive 891% spike in tariffs. This cost them about $274 million due to new trade policies. Finally, related party transactions. They owe about $134 million in accounts payable to a company called CompuWare. Now, CompuWare is a related party that manufactures motherboards and components for them. Heavy reliance on related parties is always something you want to keep a very close eye on to ensure margin and pricing fairness.
And finally, Section 6, the bottom line. Here's the final verdict. SMCI is a high-growth AI infrastructure builder with absolute, undeniable top-line strength. However, the main thing to watch is their ravenous, debt-fueled appetite for working capital. The growth is incredibly real, clearly evidenced by that 122% revenue jump, but the cash burn, that is the critical vulnerability. If you are tracking this next quarter, watch 3 things closely: the operating cash flow trend, the inventory levels, and whether they have to draw down even more debt just to keep this massive engine running.
So I'm going to leave you with this provocative thought. Can SMCI actually scale their cash reserves fast enough to survive their own hyper-growth? It is a fascinating high-wire act for sure. That's your Edgar brief on Supermicro Computer. Remember, this was a translation, it's not a recommendation. Go read the original 10Q on sec.gov if anything we talked about today piqued your interest. Thanks so much for having coffee with us today at the Edgar brief, and we will see you in the next filing.